Okay, good morning, GPAR. Matt Braden here from the professional staff. Happy Friday. Hope everybody's having a great day and a great week. Before we get started with our official presentation today, just a couple of things I would like to bring to everyone's attention or remind them of. We have a couple other workshops coming up very shortly. Next week, we have the Housing and Community Reinvestment Workshop, and that will be on Wednesday at 1 o'clock. Hopefully everybody saw that email. Check out the details about that. That's being hosted by our diversity committee, as well as the Philadelphia Metropolitan Board of Realtors. So we're really grateful to have that collaboration with them. So hopefully you guys will tune in for that. We're going to have some folks there from Fulton Bank helping us out with understanding Community Reinvestment Act updates, different grants that are available during COVID-19. So hopefully you guys will join us for that. And then fast forwarding to Friday, November 6th, we're going to have our agreement of sale workshop. It's a 3-hour workshop. I know that sounds a little bit long and daunting, but it's a really, really great workshop. It's for the newbie as well as the seasoned and grizzled veteran. We encourage you guys to tune in for that. It's hosted by Trent Pettis. It's one of our most popular workshops that we do. Trent does a fabulous job, walks through the document, fields your questions. It's a very free-flowing conversation. So it's a really helpful thing. And obviously, you guys are dealing with that document the most out of anything, right? So where it all kind of starts. So we're very grateful to have Trent do that presentation for us, and hopefully you guys will join us. Keep an eye on your inbox for login information on that. So now we get to today, economic update. We are so fortunate to have this presenter with us, Dr. Lawrence Yun from NAR. We are super grateful to him. This is his third time joining us in about 10 months. He was here in April. He was here in person when we were allowed to do those sorts of things. Imagine that, getting together for the meeting that we had back in December. I think it was early December or end of November for our general membership meeting at the Union Hall down on Delaware Avenue. The good old days, right? Where we could all be together and enjoy a presentation. So we were very fortunate to have him then, and we're very fortunate today. NAR has been fabulous to us during this pandemic. Having various leaders and experts from within their shop join us for these different kinds of conversations. So we're very appreciative of Dr. Yun joining us. And with that, Dr. Yun, the floor is yours. Welcome to Philadelphia. Thanks for joining us again.
Thank you, Matt, for the introduction and the invitation to visit Philadelphia. When I was last there, I always see the realtor spirit. I believe that one of the community award that you were giving was a service dog for a disabled veteran. I think that's the community activity. I am almost amazed at all the spirit that the realtors community engage with their community. The housing market condition here in October are looking much better than anyone anticipated, much better than what I anticipated. Back in March, I remember I got a lot of call from the media when we had the lockdown, the economic collapse that was impending due to the lockdown, that are we going to have another foreclosure crisis that we had 10 years ago? And my answer to that was, definitely no, not the degree of what we saw, because the fundamentals are different. We don't have that easy subprime lending that overstretched people's budget. Back 10 years ago, we had sound underwriting this time. And the second is we didn't have overproduction of excess homes. We, in fact, had an inventory shortage. So I thought the home prices would remain very firm even through the pandemic. What I did not anticipate was home prices to be rising this strongly with just buyers simply rushing into the market. So let me try to show you what has occurred and what you can anticipate going forward. As an economist, I speak better with PowerPoint, so let me upload that into the screen. Bear with me as I do this. Okay, and I need to go to the home page. Let me see. Okay, you're getting all the preview of what I will be discussing. All right, so here we are. So let me first start with the job market condition. And this is a 20-year job market situation in the US. The middle of the chart, the little hump that you see is the subprime-led boom, economic boom. In hindsight, we know that was a mistake. You don't give out mortgages without income documentation. You don't give out mortgages that overstretch people's budget. But we did it, and America provided that, and that we suffered the consequence of the foreclosures. But from the low point in 2010, America experienced the longest economic expansion ever, 10 straight years of job creation. President Obama, President Trump, 10 straight years of job creation, amazing economy that in America with an exceptionally low unemployment rate. Then in the month of April, the first month that we encountered the lockdown, I mean, it was from mid-March, but the April would be the total month when we faced the lockdown. We lost all that 10 years of job creation in a single month. So 10 years of job creation gone in a single month. But as you can see in the more recent data points, jobs are slowly coming around. We are far from normal. We need another 10 million job creation just to get us back to the prior peak level, but at least we are moving in the right direction. If we look at the Philadelphia Metro Division, so I think this data actually exclude Wilmington, Delaware, and even the suburbs around Trenton, New Jersey. So this is really looking at the Philadelphia and the suburbs. So what you see is for the middle of the chart, you really never had that deep foreclosure crisis. I know that there was some subprime and some foreclosure, but you never encounter that deep condition as most other parts of the country experience. But there was really no job addition for the decade. Then you see from about 2014 job creation occurring, but you lost all that job in a single month from the lockdown. And as you can see, just like the US, with the reopening in the economy, jobs are slowly coming around, but not back up to the prior peak. A good way to demonstrate what's happening in Philadelphia and the rest of the country is the following chart. So you see Pennsylvania, and by the way, I guess the Keystone State is the bellwether for what's going to happen on the election. So when Pennsylvania announced the election result, maybe we know pretty much what's going to happen for the rest of the evening. So Pennsylvania, you see at 7.8% negative. What does that mean? That means you have, or the state of Pennsylvania has essentially 7.8% fewer jobs compared to the rest of the country. Early this morning, I spoke to a group in New York. They were down 11.2% in terms of job situation. So that is actually a little larger decline compared to the rest of the country. In fact, if you look at like Utah and Idaho, they're almost back up to their prior peak levels, almost essentially matching up with 1 year ago. So what explains for this large difference? And it is the governor's decision as to how long to place the lockdown and how strictly. So in states where they had a strict lockdown for a longer period, like New York, Pennsylvania, Michigan, California, you see job situation being worse compared to states where they decide to reopen the economy sooner and in a more relaxing way. So whether it is Utah, Georgia, South Dakota, the job market is much better. But also there's a large trade-off. The coronavirus cases in New York, Pennsylvania appears to be manageable, while Utah and Georgia, they're hitting new highs in terms of new cases. Now, fortunately, due to medical advances, the death rate is much lower now compared to back in March, April, but nonetheless, is a tough trade-off that many governors are deciding. Do you try to vanquish the virus with a stricter lockdown, or do you try to reopen the economy so people can go out and about and do their business? But in Pennsylvania, again, a little larger decline in terms of job situation because the state wants to contain the virus more readily. If we look at where job losses are occurring, it's primarily occurring at the frontline workers, lower wage industry. Hotels, big job declines. People working at the restaurant, big decline. Retail stores. But in the home construction, because we need to build more homes, it's fairly neutral. While finance and insurance, all those office employment in Manhattan, for example, they're actually slightly positive. So the strange thing about the current economic downturn is that it is hitting low-wage industry, while those who are able to work from home are fairly immune. So you can see the green bar, the typical income difference between different sectors, the weekly earnings. One of the things that NAR is constantly mentioning to all the policymakers, whether governors, the city mayor, the county commissioners, or even at the federal level, to say, can we move some people who lost job from restaurant and the hotel, give them the vocational training to go into construction? First, we need more home building because we are short on inventory. And second, home construction job actually pays more than the people working at the restaurant and a hotel. So maybe we could do something where we need the jobs and also at a better paying situation. Personal income situation in America actually did better during the pandemic months than on the normal times. In normal times, family income would rise about 4% each year. Pandemic, it rose even faster. And you have to scratch your head and say, well, what is going on? And what's happening is the massive stimulus package. Bipartisanship in Washington is a dirty word today. But back in April and March, there was a bipartisan stimulus measure to say, let's give $1,200 to the tax filers, additional amount if they have a dependent family members, and also the enhanced unemployment benefits. Someone who lost a job, say at Macy's, filed for unemployment insurance, and what do you know? Their unemployment check is actually higher than the wages that we're receiving at Macy's. So massive stimulus support for the economy, and hopefully some of the realtors also took advantage of those financial resources during the business disruption period during that early months of the pandemic. What are people doing with this income? Well, they're not spending. If you cannot go see the Eagles game in person or go to the restaurant comfortably, people are simply saving up that stimulus checks. So what this hints at is that once the vaccine is discovered, and we know the vaccine will be discovered, whether later this year, early next year, American ingenuity, we can always solve the problem. So once the vaccine is discovered, we know that spending, consumer spending could be unleashed positively, really drive the economy forward. So right now, there is a potential for consumer spending growth strongly once the vaccine is discovered. There's a sizable savings that people have done during this pandemic period with the stimulus package. Currently, where are people spending and not spending money? Spending more at beer, wine, liquor stores. And you may say, well, people are trying to drown out their sorrows. And actually what's happening is that people are drinking more at home because the bars are closed. So you can see that restaurants and bar spending is way down. So it's just more of a switch. Online shopping is up, no surprise, but maybe you did not know that it was up 20%. Building material and gardening up 12%. Home Depot CEO has indicated their revenue growth at Home Depot is amazing. He never thought that it would be rising this fast. So as people are spending more money for home remodeling, home gardening, something special is happening in America. They are spending more time at home and they want to upgrade their homes. Also, as people are spending time at home, they're getting bored. So they are going sporting goods stores. I think I'm speaking a little fast, so let me pause down because my throat is making me cough. Yeah, I'm all fine and all good, just needs to slow down. So people are spending more for like bicycles and video games as they're, again, staying at home more frequently. Spending less at gas station, restaurants. If people don't have to go to office so frequently, why do you need new clothes? And also spending on good gifts and souvenirs. So any tourism-related industry has been hard hit. And also graduations, college graduation, high school graduation. If you cannot meet in person, evidently people are giving smaller gift. If they are meeting in person, they're giving much more substantial, meaningful gifts. So you see the spending pattern currently as to what's happening. Now let's turn to the great news, housing sector. Home sales coming back out of the pandemic in a very positive way. September home sales up 20% compared to 1 year ago, 20%. So last September, many realtors would have said it was pretty decent. This year is doing better than before. New home sales, newly constructed, what the builders built, up 44%, indicating that whatever the builders build, they have no problem finding the buyer. Very strong demand. Pending contracts, all-time high, indicating that this autumn would be the best autumn season ever. So you compare autumn of this year versus autumn of other years, it looks to be one of the best, if not the best, autumn season ever. What do realtors say to their clients to demonstrate seriousness? Get a mortgage. So what are consumers doing? They are applying for mortgages, and mortgage application to buy a home is up 20 to 30% depending upon which week you are looking at. So there is plenty of potential buyers in the pipeline ready to hit the market. This winter will be one of the best winter season ever for home sales. I know that there are seasonal patterns, spring, summer, much better than autumn, winter. But if you look at the winter of this year versus winter of other years, it will be one of the best, if not the best, based on number of people in the pipeline. And look at the curve. It looks like a V shape. So it's a housing market is not only a V shape, but it's a super V shape. It's doing better than 1 year ago or before the pandemic. A very good condition. President Trump wants to say that economy is in a V-shaped recovery, and I would say that's a stretch because rest of the economy is not following this path. I mean, commercial real estate is hurting right now. The airline industry is hurting, hotel industry not fully back up, but the housing is clearly showing that one of the sectors were clearly showing a V-shaped recovery. But one thing that it could hold back the housing market boom is lack of inventory. Because of lack of inventory, you often see multiple offers, especially on those mid-price homes. And if there is a multiple offers, by definition, there's one winner and multiple losers. And everyone has to start all over again. And that's a big headache. So we need to ensure that we have a balanced market condition. And the only way to achieve that is to bring more inventory. And how do we do that? Well, we need more home building. It is the home building that truly brings those empty homes onto the market. Generally, it is not for the first-time buyers. It is for trade-up buyers. But as people buy those empty homes, as they're trading up, they're releasing their existing homes onto the market, often for the first-time buyers. So we need that chain reaction of inventory with more building activity, more construction workers going into the industry, because we are short on inventory. And that is why prices are rising very, very strongly. In some markets, rising at double-digit rate of appreciation from 1 year before. One trend that is occurring also during the pandemic is that more consumers are seeking residence out in the suburbs or in the rural community or smaller town and away from city centers. And even in the resort areas, generally it should be less than 10%, but now showing better than 13%. So what explains for this trend? Well, rather than make a guess, I just talk to the realtors, ask, why is your client making this decision? And some of the answer is the following. Some people said they were very disturbed by the social unrest that happened in the summer that turned violent. First, regarding the killing of George Floyd, is terrible. Every American should be treated with human dignity. So bring that issue to say every American, Black American should be treated with human dignity. It is to raise that issue is very, very important to say all Americans should be treated with human dignity. But some social protest has turned violent, rioting, looting, and people simply don't like that. And their clients were answering to the realtors. They're going to the suburbs, seeking what they perceive to be a safer neighborhood. But biggest reason as to why this is occurring is because work from home phenomena. They're saying their clients are saying, well, if they don't have to go to office every single day, why do they need to live so close to the city? Now, I know I'm talking to realtors in Philadelphia, so you may be concerned. Well, people begin to leave away from the downtown center and go into the distant suburbs, Bucks County and other Chester and other places. And I say Philadelphia is in a fairly neutral position. And here's why. It is the expensive cities which will be vulnerable. That is San Francisco and New York. Why have those tiny homes or tiny apartments, condominiums, paying $1 million when one can have much larger size housing in other more affordable regions? And Philadelphia is far more affordable compared to New York, Boston, or Washington, D.C., where I am from. So given this trend where people can work from home more frequently, you may begin to see that, well, they're seeking affordability. Maybe they still want some excitement of a city where they can go to restaurants. There are many universities nearby, maybe concert. So Philadelphia certainly offers this opportunity. So you may begin to see New Yorkers beginning to steadily move out. They're already doing so in the. I heard that people are even going out to the Poconos to actually people who work in Manhattan, and you may begin to see greater trend of this as people digest how much work flexibility they will have. I heard Twitter announce to their employees, you can work from home forever. Facebook believes half of their employees could work from home forever. Microsoft is now taking application from their employees who are trying to justify why they could work from home forever. And as more and more companies do this, and maybe it's not a full 100%, maybe it's some kind of hybrid, come to office 2 days a week, other 3 days work from home, people may say, yes, I am going to seek a larger size home in affordable markets. Vacation home sales are still rising much faster than other segments. Why? Work from home can also mean work from vacation home. So home sales along the Jersey shores, Maryland shores, or in the mountains and the Appalachians, Poconos, it's booming because people are essentially saying that work from home can also mean work from a vacation home. And consider, once people buy a vacation home, maybe in the past they said, well, we're going to use 2 weeks in the summer, 2 weeks in the winter. But now people are beginning to say, well, I can use it for 3 months one time, another 3 months. So there will be a steadily boost to the vacation home sales, in my view, over time. So let's review going to the suburbs. The first wave occurred in the 1950s. This is when many middle-class families, for the very first time, had automobiles. They were driving and say, Yahoo, what a great thing automobile is. So they were driving around. And if they could drive, they could buy a home out in the suburbs. But at that time, many northern states had a specific covenant and subdivisions. You cannot sell a property to African Americans. So it denied many Black Americans from buying a home and building wealth from that time. Southern states had the Jim Crow laws. Northern states had many covenants in the subdivisions. So that denied the opportunity. Second wave occurred during the crime wave. I remember the Times Square, terrible condition. People simply don't like crime. They were seeking a safer neighborhood. Third wave, I would say, is the current work from home transition. Let's remember, there are more minorities, Asians, Hispanics, African Americans living in the suburbs even before the pandemic. Now, as the trend, as every Americans will seek more homes out in the suburbs, the fair housing laws becomes more important. It's the code of ethics for the realtors. So we want to do what is right, but it's also the law of the land. You violate it, you could potentially lose a license. So let's keep in mind and let's try to do the right thing to ensure that all Americans has an opportunity for that ownership and building of the wealth. And finally, my forecast is that home prices will be rising because of the housing shortage. Many people have said, my forecast here is too conservative. I need to bump up the forecast based on what they are saying. Home sales, we missed the spring buying season, but the second half is so strong, we are actually going to be better in 2020 overall versus 2019. Then we go into 2021, job recovery will continue, vaccine will be discovered, mortgage rate will remain at low levels, and work from home will boost secondary demand, especially homeowners who are very happy with their home in January and February suddenly say their 3-bedroom home is insufficient. They need a 4th bedroom for their office space, 5th bedroom to turn it into office for their spouse. So homeowners who were happy before the pandemic is no longer happy. So this second order demand will arise, and hence the backdrop for market condition going into 21 looks quite bright. So, best to you in this good uplift in the housing sector. And thank you, Matt, for inviting me to share some of my thoughts with the great realtors in Philadelphia.
Thank you, Dr. Yoon. Do you have time to take a couple of questions from our folks, or you have a tight schedule?
Let's take 2 questions.
Okay, folks, if you have a couple of questions, drop them quickly into the chat and we will present them to Dr. Yoon. Dr. Yoon, thank you very much. It's great to get all that feedback. I'm sure it's some positive news. It definitely sounds a bit different from when we talked back in April, because it was just such an unknown. We didn't know where we were going, what the path forward was going to be. So this is definitely a very different message, I would say, than what we had then, because we're kind of seeing how things are playing themselves out. So we have a question here from Frank Giacovini. How do you see the election impacting the forecast for the future?
So the election, I get this question every 4 years. What I find is that from consumers' perspective, they buy home based on economic factors. Are their jobs secure? Is the mortgage rates low? Is homes widely available? So these are the factors that drive housing demand. I know people are very passionate about what's going to happen on the election, but in terms of buying a home, it's really a pocketbook issue. And right now, we are in that job recovery mode. Interest rates are low. I hope that we have more inventory. So it really does not impact, maybe only at the very upper end market. You may see some hesitancy, but interestingly, our latest data show that $1 million homes doubled in sales in September versus September of last year. So people are buying those $1 million homes. And I'm from Washington. We do see some swings in Washington area, depending upon which way election go. But for the rest of the country, it's really about pocketbook issue, and the demand is very strong. We just need more supply.
Okay, so we have some thanks and we have some good mornings to you. How do you see the forbearance situation affecting home sales in the coming months?
Well, thanks for that question, and I will make that as the last one, is that mortgage forbearance, the concept was, let's get a timeout, because we had the lockdown. We didn't know how the economy would recover. So hopefully within the 12-month time span, from March to March of next year, maybe people can find job over that time. But for people who lost job, at least I don't have to pay mortgage. We know that it's not a free lunch. You have to pay back whatever missed mortgage payment. But so the mortgage forbearance period is, let's hope that more jobs get created till March of next year. And also maybe the forbearance period gets extended beyond March. We don't know. But one thing I can say is the market condition is so different now versus 10 years ago. We're not going to have foreclosure crisis. When people have housing equity, so maybe people do not have to do short sales to go under foreclosure. They simply have to sell their home and get equity. Second, there are plenty of buyers, whether investors or first-time buyers. So whatever foreclosure properties comes onto the market, it will be absorbed quickly. I know we never want to see families go through foreclosure, such a painful experience, deep scar. But from market perspective, the market can easily handle any foreclosure that comes out. But let's hope for the best, that job recovery continues and people can begin to catch up on those mortgage forbearance.
All right, Dr. Yoon, thank you very much for giving us of your time today, as well as fielding a few questions from our members. To our members, thank you very much for tuning in. We really appreciate this. We look forward to doing more presentations in the future. So everyone, Dr. Yoon, GPAR members, have a great day. Have an awesome weekend. Take care. And hey, the Eagles won last night, so can't get any better, right? All right. Take care, everyone. Have a great day.